Well, it was a rollercoaster ride once more for financial markets last week, with Fed speakers sticking to the higher for longer line on monetary policy, plus lingering geopolitical risk, as well as the situation in the Middle East remains relatively fluid. Combine those two factors, and we saw the S&P 500 slip to its worst week of the year, while Treasury yields rose to fresh year-to-date highs, and the dollar also printed a new year-to-date best against a basket of peers. A marginally quieter data docket awaits market participants this week, but it is nonetheless the busiest week of Q1 earnings season, with around 40% of the S&P 500 by market cap set to report. And we also got a policy decision due out of Japan as well. And of course, incoming geopolitical news flow will also continue to be very, very closely watched indeed. It's a busy show and plenty for myself and Ryan Littlestone to discuss on the trade-off this week. So let's roll the titles and get into things. Well, as I just said, plenty for us to discuss on the show this week. So without further ado, let's bring in my co-host, Ryan Littlestone from Forex Flow Live and Forex Analytics. Ryan, I'm expecting a 5-star performance from you today, like we saw on our panel discussion last Thursday. And may I just say, I'm very pleased to see that you've taken my advice on board and smartened yourself up a little bit for our filming session this afternoon.
Well, thank you very much for your kind words about last week, mate. Very well hosted by yourself. And I'm glad to see you've dressed down and got your supermarket clothes on once again for this show. So, yeah, we've both gone one way or the other over this period. So, yeah, let's move on, shall we?
Supermarket clothes. There's a cost of living crisis, mate. It's hitting us all. It's all I can afford these days, you know, is stealing the uniform off a Tesco worker's back. It's the best I can manage at the moment. But before we go down that route and critique each other's style for the next 40 minutes or so, we do have plenty to discuss on the financial market. So let's get into Topical Thunder. So I want to kick things off this week with just a look at the general sort of turbulence that we saw in the financial markets last week. The S&P 500 and the Nasdaq both losing ground for a third week in a row. The Nasdaq incidentally down just over 5.5% on the week when you look at the front month future, which is the contracts, well, not the contract, the generic contracts worst week since April of 2022. So the first time in a couple of years we've had a weekly decline of that magnitude. And there was very much a defensive vibe to the market. If you look under the hood, we had utilities and consumer staples really outperforming, and as that move in the Nasdaq would tend to imply, the tech sector quite badly lagging. So some would say that this is long overdue, given the move higher that we've seen in some of these AI names over the last 12 months or so. Some may even point to the fact that we're seeing perhaps a rotation under the surface. That's a narrative that everyone loves to drag out when we see a little bit of divergence between sectors in the equity market. Whatever the case, I think it was interesting that the move lower that we saw in equities, I would argue it's not necessarily linked to what we see on the geopolitical front, particularly when you look at crude, for example, down around about 3% on the week, and amid signs that the sort of tit for tat between Israel and Iran, none of it really appears to have led to, touch wood at least, any further escalation in tensions or deterioration in the situation in the Middle East more broadly. So I guess you then go, what's really the driver of the equity market last week? What was driving the selling? Well, obviously you've got a bit of momentum behind it. As I said, a third weekly loss for both major indices. You could perhaps point to yields moving higher. The 2-year rose north of 5% last week to a fresh year-to-date high, but stocks shrugged that off for most of the year. It shrugged the move in treasuries off most of last year, so I feel that's a little bit of a stretch. Higher for longer Fed speak? Yeah, maybe, but seriously, we're not talking about rate hikes being on the table, and the next move is still likely to be lower, so I don't think that's potentially a catalyst. Maybe a few jitters creeping in ahead of earnings. As I said, we've got 4 of the Magnificent 7 reporting this week, and about 40% of the S&P 500 by market cap, so perhaps that putting a little bit of a lid on anyone's appetite to buy the dip last week. But what I think is interesting is that we've come into the market this morning and At the time of recording, the S&P future is up around 2/3%. It appears this morning we're in a sort of no news is good news vibe, where there hasn't been any escalation in geopolitical tensions over the weekend, and the market is taking some solace in the fact that we may be able to perhaps put that behind us and focus back on some of the fundamentals. And I think if we do get that focus back on earnings and back on the economic outlook, then that is still pretty bullish and constructive for the market over the medium term at least. But Ryan, I'm keen to get your thoughts on what I would say was a choppy and an interesting week for equities last week.
Yeah, very much so. And I think you've nailed it this morning, saying that we've got a bit of a relief rally on that no news is good news, that something didn't happen over the weekend. But I can't look at markets today, looking at them are just a complete mess. You've got yields high, you've got the dollar gaining in some pairs, not in other pairs. Gold's falling off a cliff, oil's been weak as well. So, there's so much going on, this geopolitical risk, the Fed, earnings, everything. I just think there's a lot for the market to take in at any one moment. I think we're just seeing a bit of indecision going around. As for stocks, yeah, this does look like the seller's been waiting to really spank this ever since the break of 4,800, and they've tried it all the way up. Now they're actually getting some reward for their trade. So I think they're really pushing the button on this. And I thought a close below 5,000 the S&P would be significant on Friday. It's proving to be the case today because we just can't get back above it. And you say about earnings and waiting for these earnings. Well, we came through the good financial earnings season, if you like. All the banks, they were all solid, good earnings, yet we still came down. We still saw stocks falling. So I'm not sure if earnings are going to help, at least if they're good. But I think if some sectors are looking pretty ropey, and I expect still the auto sector to do so, then that's going to be added fuel for the sellers to push the button even further.
Yeah, perhaps. I don't think it'll take much in terms of earnings misses for the bears to pounce on those. And obviously, we will watch those very closely as we move through the week. I think Tesla kick off the Magnificent Seven after the close on Tuesday, but they're something of a basket case at the moment. So perhaps Meta after the close on Wednesday are the ones that we should really be watching as maybe a broader sort of bellwether for the sector. But in any case, I'm sure we will pay very close attention to that as the week goes on. It is a busy earnings docket. It is a relatively light macro docket, however, with, I guess, the next Bank of Japan decision really the standout release on what's otherwise quite a boring calendar this week. And I'm sure Ryan is saying very interesting things, but he somehow managed to mute himself.
Oh, stop it. Sorry. I'm back.
Do you want to start that little sermon on the BOJ again so we can actually hear you this time?
Yeah, I was going to say, we have got a few bits and pieces out this week of importance on the data docket, GDP from the US, to name one of them. But Friday is going to be a big day for the yen because we get the newest set of inflation numbers from Japan via the Tokyo CPI. And this is April data versus the March national data that we got last week. It's expected to show another drop in core inflation to 2.2% versus 2.4% previously. Now, that's very close to the Bank of Japan's target, although it is Tokyo CPI. But it's coming a mere hours before the Bank of Japan decision. So that, I think, could inject a bit of spice into the yen, particularly if it's a very soft number, softer than expectations and closer to their magic 2% mark. So while inflation has been the main focus for the Bank of Japan, it is said that they are perhaps going to broaden their view onto other things, other factors like consumption, capex, rather than just their main focus of CPI. They, like other central banks recently, are also bringing FX into the conversation and its play on possible inflation moves and impact. Now, we know UEDA has already made a point about FX becoming important in their last meeting. And even on Friday, he said he sees a chance that weak yen may affect trend inflation, and if so, could lead to a shift in policy. So this now presents a sort of two intervention type risks for the yen, one through obviously the MOF and one now sort of through monetary policy by the Bank of Japan. Now, this meeting is obviously the first since the end of NIRP, negative interest rates. So there's going to be a lot of focus on what comes next. And there's very little expectation for a hike, but the FX kicker may play into things if we see another big rally in yen pairs going into that meeting on Friday. Otherwise, we'll hear whether the CPI data and other parts of the economy are sort of procuring enough for another hike, or whether or when another hike might be. So we're all looking about the timeline for when the Bank of Japan are going to move next, and how they see things in the economy right now. So going to be a spicy one. We have to wait till Friday, but that dollar yen's going to be important at this 155 level going into that.
Yes, I think it will. Are you getting up early for this one, or are you having a lie-in?
I might do, actually. I might poke my head above the covers for this. Yeah, particularly that CPI data.
Blimey. Well, I certainly won't be. I think one BOJ meeting, being up early for it in the last decade is more than enough for me, and we'll wait another 10 years for the next one. I do think it's interesting, though, and actually it really epitomizes the divergence between the Japanese economy and the rest of the world, and the BOJ and the rest of the world, in that, if we're talking about in the UK or the US or Europe, for example, core inflation coming down 0.2% to 2.2%, you'd have Andrew Bailey and Christine Lagarde popping champagne bottles and wondering how much they can lop off interest rates at the next meeting. Whereas actually for the BOJ, this data is moving in arguably the opposite direction to what they want to see, which is that inflation target being achieved on a sustainable basis. So I think, as you say, it's too soon for them to do anything just now, but the focus really will be on whether they guide the market towards expecting any further tightening, any further rate hikes, and also, I guess, the magnitude of those hikes. Everyone is saying they're going to be 10 basis points. Why limit yourself to 10? Why not go, 25, like the sort of global standard is for monetary policy authorities? So, plenty of, although they've ended negative interest rates, there's, I would argue, probably more questions than answers still around what the Bank of Japan are actually going to do next.
Yeah, there always is. And, they are a special case, so you couldn't rule it out that they're going 10 pip moves. But I think, you've got to remember we've still got this intervention risk hanging over us. And that's why it's going to be important what dollar yen does this week into that meeting and over that data as we roll into that meeting as well.
Yes, indeed. I'm sure we can talk about intervention another time, but when the Fed are saying we're pretty much going to stay unchanged until inflation is back towards 2%, and you've got a 10 basis point interest rate in Japan, I mean, come on, which way do you think dollar yen is going to go? You don't need to have a PhD in economics to work that one out. Anyway, moving on, because we need to talk about the UK. We covered this actually exactly this time in the show a week ago, where we were talking about the busy week of data that we had coming up here in the United Kingdom. And obviously, we moved through that economic data. And I think we may disagree here, because my read on it is there's really nothing in this data that will deter the Bank of England from delivering their first 25 basis point rate cut in June. If you look through the figures that we had last week, firstly, the latest employment data, unemployment rose 4.2% in the 3 months to February. That's up from 3.9% in the prior month in January, and also a 6-month high, although obviously we must apply the usual caveats around the quality of that data, with the ONS being now the Office for National Shambles rather than the Office for National Statistics, such as the ridiculousness of the situation that's going on there. Just give us some data we can rely on, for goodness sake. But more importantly than that, earnings pressures are still bubbling away. Average earnings, regular pay, continuing to grow up 5.6% on a yearly basis in 3 months of February, which may be a little bit concerning. But on inflation, nonetheless, we did get some good news. CPI down to 3.2% in March on an annual basis, a little bit above the 3.1% that was expected and that the BOE had forecast, but nothing particularly disastrous. Core CPI also coming down nicely. Again, just 0.1% above where the BOE expected, coming in at 4.2% in March on an annual basis. But we're still on track to achieve that 2% target in the spring as the impact of energy prices feeds through into the data. And what I thought was interesting was some comments from BOE Deputy Governor Dave Ramsden relatively late on Friday, where he was saying that actually he sees that the risks to the inflation outlook in the UK are now tilted to the downside, which is the first time probably this cycle that we've heard that from a BOE policymaker, and that is relatively dovish, I would argue. And then on Friday, we had some relatively poor retail sales figures. Sales excluding fuel were down by around about 1/3 on a monthly basis. And when you look into that data a little bit more, there were pretty chunky drops in both department store and online sales, those segments really struggling on a monthly basis in March. So that may maybe a sign that consumers are continuing to tighten their belts, and that the cost of living crisis is continuing, and that spending is relatively sluggish. So nothing in all of that for me pushing back on my idea that the BOE are going to deliver that first 25 basis point cut in June. The other thing to remember is that the minutes from the March policy meeting that were out a few weeks ago made very clear that the policymakers see rates remaining in restrictive territory, even if they deliver a rate cut, which means the BOE can go 25 basis point cut, but leave all the statement around, we need to stay restrictive for as long as necessary to bring inflation back to target. They can leave all of that in the statement, as is pretty much in common with every other G10 central bank. What's interesting, though, is that the market still prices June as about a 50-50 chance. So there is room, if we are to get, say, a dovish statement from the BOE in a fortnight's time, or some further relatively mixed economic data, there is room for that pricing to move a little bit further. But Ryan, I get the impression you may disagree with me.
Yes, I'm going to disagree slightly. I think the market
I knew you would.
Yeah, well, it's standard, isn't it? I think the market's getting overly dovish. It's on its way to getting overly dovish. Let's not beat around the bush. Ramsden took an absolute barstool to the back of Cable's head on Friday. Some of those comments. The key comment from me was that he said inflation is going to drop close to 2%, not closer to, not it might be on its way. It will drop close to 2%. That's a pretty big call, considering we're not going to get an inflation print until after the May 9th meeting. So either they know something we don't. We know that we're likely to see a drop in inflation due to the energy price cap, but there's still plenty of price pressures bubbling elsewhere, especially from those wages. I don't know if we're going to see some of the bonus numbers still, having a little bit of a play in those ONS numbers. I like your description as well, Office for National Shambles.
I think I may have stolen that from you and Smith at one point, so I can't claim that as my own, unfortunately.
I'll match that off with my Office of Bodged Responsibility for the OBR. So we should have got a 3-for-2 deal with Bernanke on forecasting for all those three: BOE, OBR, and ONS. But anyway, moving on. CPI, it came in softer, but I think they both beat expectations by a pip, so it didn't drop as much as expected. But this Ramsden thing, I think he now needs to vote. So we should at least be getting 2 votes for cuts at the next meeting based on Ramsden's comments. We know that Dingler was the only cutter on the MPC at the moment. So he's got to be another one now. If he's come out with all this and he doesn't actually vote for it, well, that's going to put the cat amongst the pigeons and make a complete shambles of an already shambles institution. But the market's moved from September to August pricing now after those comments. He's got to back it up. The data's got to back it up. If it doesn't, we're going to see the pound shooting higher again. But I don't think June's on the table personally, but who knows what these clowns will do.
Well, I don't think they even know what they're going to do at this point. We shall see. The one last thing I would make on the BOE, though, is I think it's interesting. You're seeing a bit of a divergence open up between the internals and the externals on the MPC, because if you listen to what Haskell has said recently, and Megan Green had a big piece in the FT a few weeks ago, they're all talking about upside risks to inflation, stubborn services inflation, sticky prices, et cetera, et cetera, et cetera. And then you've got the Deputy Governor, Dave Ramsden, who has been on the MPC for probably getting on for a decade now, coming out and going, no, I think the complete opposite, risks are to the downside. So it's going to be interesting how, or indeed even if, they square that circle. And, do we get to June and we have, a very narrow, well, it would be 6-3, you would presume, all of the internal members plus Dingra voting for a cut, and then Haskell, Green and Mann saying, no, we're happy to hold where we are. So I think that's going to be an interesting one to keep a close eye on. But as you say, that May vote split will be absolutely key in terms of a signalling mechanism. And of course, we get the new BOE forecast in May as well. So it'll be interesting. This is before Bernanke's scenario nonsense comes into play. It'll be interesting to see what the BOE have to say in their latest forecast at the next meeting in a couple of weeks. But we can cover that in next week's show. I'm sure we've got other things to discuss this week, including the foreign exchange market.
Yeah, FX, it's become a big thing at the moment, and what a strange world we live in. We got central banks always telling us that they are independent of the Fed, and that the Fed sets policy for the US and the others set policy for their own countries. So what I want to know is why all of a sudden are many central banks remarking about how the possibility of the Fed not cutting may harm their policy moves. On top of that, we've got now pretty much every central bank talking head making tepid noises about their currencies and how, again, that might be impacted by Fed policy and how it might influence inflation. Now, we know all central banks talk to each other regularly, and while they won't admit it, they tend to keep monetary policy closely aligned as global economic trends develop, much like they did in the hike cycle. So far, though, we've had Bank of Japan, ECB, BOE, and the Fed all mentioning FX in recent speeches. Most notably was Ueda, as mentioned earlier, and also Lagarde, who said last week they were monitoring FX very carefully. Now, considering the euro's been stuck in a rough 500, 600 pip range for nearly 18 months, one wonders what exactly it is she's worried about. So my question is, G. Michael, are we about to see some fractures in relationships between the Fed and the rest over worries about the strength of the dollar, or are central bankers just, preparing some excuses in case FX levels help change the inflation picture?
Well, give me the easy questions, mate. Bloody hell.
I'll back then while I wait.
Well, I was just thinking it would help if I read the notes to this show before we started. Then I might have half an idea of what to say. It's like being back at school when you haven't done your homework. It's an interesting one. I will get you an answer. Just give me time. Okay. It is an interesting one. I think it goes back to what we were saying about the BOJ, and the Ministry of Finance. What do you expect to happen if the Fed are on hold and you are cutting rates because you have to, because growth is fragile, because inflation's back at target? Whether you're the ECB, the BOE, the SNB, who have obviously already delivered the first 25 basis point rate cut. What do you expect to happen? Of course, your currency is going to soften as a result of that. What I think is probably most interesting is the fact that none of this seems to have come from market participants. You think back to the April ECB press conference. If you shut your eyes and just tuned out the French accent, those questions could have been to Jay Powell in Washington, D.C., rather than Christine Lagarde in Frankfurt. Such was the focus on what are the Fed going to do next? If the Fed do this, what does it mean for you, et cetera, et cetera, et cetera. I think, ultimately policy will be relatively synchronized. Yes, central banks are going to ease at differing paces and to slightly differing magnitudes. But, if we're talking about the ECB delivering the first cut in June and say, I reckon the Fed will probably go in July, but let's say they go in September instead. It's 3 months, it's 4 months. Is that going to cause a sustained move lower in the euro? Maybe. But I think, ultimately central bankers are going to be forced to make policy based on what is happening within their economies. Can you imagine a situation where, let's say the UK slips back into recession, inflation is well under the 2% target, we're 3 or 4 months out from an election, and Andrew Bailey stood in Threadneedle Street going, no, I'm not going to cut rates because Jay Powell hasn't yet, and I don't want cable to go below 123. Good luck with that.
No, exactly. And the same with Lagarde talking about FX. If the euro was trading around parity just on the back of the Fed not cutting and the ECB cutting, you may think they've got a bit of a case. But, you can tell she's not an FX trader or any sort of trader and, more of a lawyer as she is. But, we're not seeing any vast FX moves, and we shouldn't really when we're talking about, like you say, there may be a difference of a few months here and there, but they're all going to be heading the same way with rates at some point because they want to get down to that neutral level and back to some sort of normality. It just strikes me that they're all coming out with these little excuses and little reasons. Maybe they are, really scared that inflation's going to come back and bite them in the butt, a bit like it might be in the US. And they're just prepping everyone for their excuses that they're going to try out once their credibility gets questioned yet again.
Yes, indeed. And then they'll all do what the BOE did and just commission a review for the sake of reviewing things, just to say that they've done something and point at it as an excuse. But ultimately, yeah, I mean, the broader direction of travel for all central banks, excluding the BOJ, of course, is towards easier policy. And I think that should broadly keep a lid on equity vol, maybe not FX or rates vol, because obviously they're going to be moving at differing paces. I think the only thing Lagarde is trading, just to go back to that, is fake tan. She's massively long that, clearly. But apart from that, I don't think she's got any positions on her book at all. Speaking of positions and speaking of our books, let's have a look at some charts in That's a Setup. The segues on this show get smoother every week. Right, let's have a look at cable. First of all, it's been a torrid couple of weeks for the pound, and last week was no exception. Of back-to-back weekly losses for cable, and we finally saw spot break below the 125 to 128 range that's been in place pretty much for 5 or 6 months now, all the way back to last December. We were as near as makes no difference in that range pretty much every day. We had a couple of brief forays outside of it, but last week was a definitive break to the downside. Now with spot trading to its lowest level since November and about 40 pips below when I took this screenshot yesterday, it does look like the bears are well and truly in control of things for now. It feels somewhat inevitable that we're going to get at least a test of this 123 figure to the downside. And I guess the question then is what happens after that? And I think it hinges back on what we were discussing previously. Firstly, how much further the BOE want to lean into the idea of cutting in June. As Ryan rightly said, Dave Ramsden clobbering cable into the close on Friday. Do we hear a similar message from any of the other BOE speakers? We hear from Chief Economist Hugh Pill on Tuesday, for instance. And I think the other thing, of course, is how much the FOMC lean into this idea of rates remaining higher for longer. And the next Fed meeting, of course, not far away now on Wednesday, the 1st of May. And also we have a Treasury quarterly refunding announcement on that day as well, which is an influence if you're trading treasuries out there. I think my bias is probably towards further downside, but I would caution that it's probably one where you don't want to get particularly greedy. We were just discussing how levels of FX volatility remain relatively low, and we've seen how range-bound cable has been over the last 4 or 5 months. So I wouldn't be too surprised if some shorts did look to take some profit on these positions relatively shortly. But I'm going to quote you here, Ryan, as you so often say, the trend is your friend, and that is certainly the case for the bears at the moment.
Yeah, very much so. And you're nearly tagging your 123. I'm looking at the screen just to show that we are doing this while watching market. We've had a low of 123.04 at the moment, so it's right on the level there. And I think if that goes, then we're heading for that 121, 120.50 zone that we hit late last year. And that's going to be a big test for this pound weakness, irrespective of what the BOE may come up with. So I think, yeah, we're getting to some interesting levels here. It's always the case with the pound, and we've said it before in the UK, either things are going remarkably well or, the world's falling apart. And at the moment for the pound, the world's falling apart. We're also seeing that in euro sterling as well. So, yeah, there's some decisions to be made about this one. It looks like a rally sell. If we hold 123, though, we could be setting up for a bit of a similar situation to what we're seeing in euro dollar and that 106 level, where enough's enough. That's where the buyers are going to come in and step in, and maybe we just see a bit of consolidation. But definitely going to be watching this one with interest over the next few days.
Yes, indeed. You can tell that one of us has got screens in front of them and the other hasn't when we're doing this recording. But, I'm clearly not exactly sticking my neck on the line with that call for 123 and, that massive 4 pips of downside that I'm now calling for. In any case, another chart that I'm sure we're both going to be watching very closely, when I get back to my desk at least, is the S&P 500 this week.
The S&P, and this one, another one that's looking like it's really under the cosh at the moment, and what a difference a couple of weeks makes, eh? Since last November, you couldn't get a dip for love nor money, and now it can't rally at all. And while we discussed some of the drivers earlier, I wanted to look in depth at what's happening and what might be coming next. We're now finally carving through all the support levels at a pretty hefty clip, a big support level at 50, 40, 50. Built up during the rally, that broke and saw a quick move down through the 5K level on Friday. Though the first move came after those Israel headlines, so you have to take that for what they were. But We did stage a bounce back above the 5K level, but we closed the week below it, and that was very important for me. And it looks like a potentially very bearish continuation here. Now, we've had an area of support below here, which brings some context to the recent drop. So as much as we're seeing this big move off the highs, we're not yet at the 38.2 fib of the whole rally since late October. So that fib around the 4,800 break point is going to be hugely important and the real test for this rally. Now, last week I had a little nibble at that 50, 40, 50 area, but when that level failed, I was stopped out. And also I got stopped out in the balance of my break longs that I've been sitting in from that 4,800 break. I then had one further test on Friday, just under 5K, after those Israel headlines sort of started washing out. I ended up scratching that. So I've had a couple of attempts now to buy the dip and it hasn't worked. So I'm not going to be touching it now until maybe we get a test of that 38.2 fib and that big zone near 4,800. Now, if that level fails there, we might have an even deeper correction following. So for sellers, broken levels on the way down, like that 50, 40, 50, will likely be the main resistance points now on any bounces. And sellers, they've really got the balls by the horns. And if they keep pushing it lower, we have to see what happens down at that fib area.
Oh, dear. I don't know what's going on at the moment. Everyone I speak to is so bearish. I mean, you're as downbeat as anything. Westy seems all down in the doldrums about where equities are going. Blake was being bearish on the Aussie version of the trade-off last week. I don't know what it says for sentiment when, the grumpiest man that Pepperstone employs is still bullish and happy to be buying the dip. Maybe I'm wrong, or maybe I'm being a bit contrarian. I don't know. But I think, closing below 5,000 is important. I would say, to counter that, the futures haven't closed below 5,000 yet. And obviously that is, I would say, perhaps more important if we get a close below 5,000 there. But more important than both of those is the fact that we've managed to hold on to this 100-day moving average. And we're bouncing quite nicely off of that this morning. So I think if that can hold firm as support, then the market may begin to find a little bit of a base. This no news is good news vibe is going to help over the next couple of days, you would imagine. And then we roll into earnings. And that's going to be the key test. What do we hear from Meta? What do we hear from Microsoft? What do we hear from Alphabet or Google or whatever you want to call them? And how does that support sentiment or even dent sentiment as we move through the remainder of the week? But I think over the medium term, I'm still pretty constructive on risk. I think my bull case for pretty much the entire year has been predicated on the idea that growth is going to remain strong and we should get another GDP print above 2% later on this week, that should keep earnings growth relatively well supported. And we're seeing that so far in earnings season, even if the market reaction hasn't been quite as positive as you might like. And the third thing it's been predicated on is that the Fed, if they want to, they can cut rates whenever they want to, and they can step in with liquidity whenever they may need to. And thus far, that is still the rhetoric that we're hearing from Fed policymakers. Unless that changes, and unless anyone at the Fed, anyone serious at the Fed, not some muppet like Kashkari, comes out and says, we are considering moving rates higher if we get another hotter than expected inflation number, which is not the base case in any way, shape or form, then I'm probably going to remain constructive on risk until any of those three factors change.
Yeah, well, I thought you were the most grumpish man at Pepperstone, so it's a bit Richie blaming other people as well, pointing other people that way. But anyway, I think these earnings are going to be very important for their reaction. As I said, we came through all the financials and stock still dropped. If these earnings are pretty good, if they're good numbers broadly across all the sectors, but stock markets can't rally on that, then that's a big message, a big signal the market's telling you. So even for someone who's happy to look at trying to buy a dip myself, that'll be something I'll be thinking, oh, hang on a minute. If we can't rally on good news, there's only one other way we can go, really.
Yeah, sideways.
I can't argue with that.
I know. Right, moving on. Speaking of something that is going sideways, you see another one of those segues coming in. The 2-year Treasury is, as near as makes no difference, back at 5% into the close on Friday. We had a little look north of 5% in early trade today, and we're still pretty much just shopping around that level this morning. And I was thinking about this over the weekend because, I like to live a wild life, that on a Saturday morning and look at charts of the bond market, what else are you going to do? And actually, I'm starting to like the idea of buying the front end of the Treasury curve. And I think quite a few other people in the market are going to be thinking along similar lines. Now, obviously, you've got a bit of term premium and a bit of risk premium in here as well. But in essence, what a 2-year yield at 5% is saying is that the Fed are going to cut less than 50 basis points over the next 24 months. Now, I would argue that that is a sign that the hawkish repricing we've seen has gone far too far, far too quickly. Now, there's the risk that we may get another 1 or 2 upside inflation surprises. But looking at the bigger picture, we're talking about locking in a 2-year yield at 5%, somewhere between 3 and 6 months before the Fed kick off their easing cycle with the first 25 basis point cut, whether that comes in July or whether that comes in September. And I think at an institutional level, that is going to start to prove a little bit too alluring for many market participants to resist. So I fancy being long the front end of the curve here, although I would caveat that by saying I wouldn't mind waiting until tomorrow's 2-year auction, which I think is about $65 billion worth, is out of the way before opening that position, just to see how supply is absorbed. But at the same time, looking at the broader Treasury curve, I think we're still in this environment where rates are going to remain higher for longer. We are going back to a neutral level, as Ryan said earlier, but that R star is likely going to be higher than we had previously been expecting. And as a result of that, you should see the long end continue to sell off, or at the very least, hold roughly steady where they are. And as a result of that, you should see the curve in turn continue to steepen. And that is especially the case if, as most of us, I think both of us and a few others in the market now expect, the Fed are going to move to targeting an inflation band rather than targeting inflation getting bang on back to 2%. So steeper curve, front end yields moving lower, 2-year Treasury rallying. That is what I'm looking at when it comes to the Treasury market at the moment.
Yeah, it's a very important viewpoint as well. And for any traders who they're not big on bonds or the curves or what it implies, the 2-year is a good marker, good rule of thumb as to what the market expects for rates. And as you say, trading at 5%, we're above, the 2 cut expectations a lot of people have got, that the market have got, that the Fed have got. So from that aspect, it's a good chart to keep an eye on. I think for the dollar as well, this one is going to be pretty big. If we break above this 5% mark, which, as you can see from the chart, we've tried several times now to do so and can't. If we break above that and tens follow, say getting above 4.7%, then that's going to be the kicker for the dollar to maybe take another leg higher. That'll probably do for euro dollar at 106 and likely then push to 105. The same for cable. That'll be another downside kicker. So there's a lot of eyeballs on this and a lot of things that can happen should we get a break here. But does it break before we get to the next Fed? I don't know. We might have a couple of little looks above it. But I think definitely after the Fed, where this yield is trading after, is going to be a big signal for where the dollar goes next.
You're going to say, does it break by the time this show goes live for a second now? I bloody hope not. My play of the day had gone wrong before the show went live last week. We can't have that 2 weeks running. Right, let's move on to our last chart, which is the shiny yellow metal that is gold.
Yeah, well, this one I've had to rewrite about 20 times a day since I did it last night. I thought I was going to come in and have a nice trade this morning, a nice short, but didn't get close. But anyway, there's one or two things happening in gold now. It's either running out of steam after such an incredible run, or it's just pausing to suck in a few more shorts before busting another move higher. I will still admit I really don't have any solid reasons why it remains or had remained so well bid. I still favour that we're seeing a lot of heavy Chinese buying as the main reason, but that's just my opinion. Irrespective of that, we found a bit of a wall up here at the 2400 level. The two main drives above were on the Iran and Israel headlines, and those are still a risk for gold, and probably one reason why it's not straying too far to the downside. However, it has been going up without those risk headlines previously. So this period might just be one where this Iran-Israel noise is affecting things, but not really the main driver. Now, as I said, I did come into today fancying a short up at 2400, but since I've sat down, it's done nothing but sell off. We've moved through short-term support level around 23.65. We're now heading down towards the next support area at 23.20.25. And I think I might have missed that boat for short, but we shall see. Now, this might sound like your typical top-picking idea. And while I'm one of the biggest warners against trying to do such things, I always say it's okay to do so if you have a good reason or evidence as to why you want to try picking a top. And my evidence for this is that we've gone 2 weeks now without another significant upside move above 2,400. That's very similar to the price action we saw in the S&P at its highs. So these similar price patterns are following route, and it seems to be playing out today as we trade around 23.33 at the moment. Now, another bounce from here back to 24 will have to be judged for the reason why it's moving up there before I think about taking this trade another time. But for now, we're going to need to see where this is going to dip to. Is the buying activity that we saw before this risk stuff going to step in again, or have we indeed cemented a proper top up here?
Yeah, I'm in the same boat as you. I've got absolutely no idea what's been driving gold higher over the last, month or so now, I guess it is. And no idea what's driving it lower today. Apart from this kind of no news is good news, and risk seems to be relatively on, albeit stocks moving a bit lower after the cash open. I think the only thing I would add is that if the move higher has been based on inflows, whether it be retail or institutional or central bank or whatever, that's always going to be relatively opaque and murky, whether that be on the way up or on the way down. It's the sort of thing that we only really find out about a month after it's happened, when all the data gets published. So just be a little bit cautious of that one if you are trading gold based on those flows. But I think really if you think more broadly about how gold has traded over the last 4 to 6 weeks, it has almost been a pure momentum trade. The move higher was pure momentum based. Momentum works in both directions. So obviously it's only been 1 day of declines at this point, 2% or so. If that becomes 2 or 3 or 4 or 5, then that momentum could pretty quickly spiral, and some of these gains may unwound. And as we both mentioned on the show a few weeks ago, these fundamental relationships between gold and the dollar, gold and yields, gold and risk, do they then start to reassert themselves, and we see gold move back lower as a result of that?
Yeah, it's a very good point. We've had this correlation discussion before. Correlations are a lot of them are right out the window at the moment, but sometimes it doesn't take much for them to swing back round again. But, I was having this discussion this morning in one of our chat rooms. Someone was saying about, what's going to happen with the dollar with gold moving, or what's going to happen with gold now the dollar's moving. You don't know. The correlation's been broken for so long. Just treat them as individual assets. There's a chart for each of them. Just trade them as such, and don't get too caught up in why one might be affecting the other, because you just create yourself a headache.
Yes, indeed. You are absolutely right. Right, with that said and done, let's move on to our plays of the day. Right, I'm in the FX market this week. Well, we both are, in fact. I'll keep things relatively short and sweet, because the environment we're in at the moment in the foreign exchange space seems to be one where policy divergence is really the main driving force behind most G10 currencies at the moment. And that begs the question of which currencies are likely to benefit and which currencies are most likely to be disadvantaged by the fact that the Fed are keeping rates higher for longer, and that the balance of risks is tilting more hawkish towards later and fewer rate cuts. On a very simplistic level, you would say that currencies where central banks are going to cut sooner and cut to a greater degree than the FOMC are likely to weaken against the dollar. And that really does put Europe in the crosshairs. If you think about things, the SNB have already cut rates, as we mentioned earlier. The Riksbank in Sweden likely to deliver a rate cut this month. And the BOE and the ECB, certainly the ECB, are pretty much nailed on to deliver a rate cut in June. So this week, I'm looking to be long the dollar against a basket. We'll call it an equally weighted basket of the Swedish krona, the euro, the Swiss franc, and the pound, because I think European currencies are in for a relatively torrid time at the start of the summer, at least until that first Fed rate cut is delivered. Ryan, you're looking at something that doesn't move.
Well, I thought I'd pick something that might stand a chance of still being valid by the time we got around to filming. So, I've gone for something. It's potentially a good trade. It's one I like trading a lot. It's been a while since I've traded this, but this is the dollar, Hong Kong dollar, and it's on its way back to the top of the Hong Kong Monetary Authority's price band once again. That price band runs from 775 to 785. And the HKMA are really stout defenders of the band and have seen off plenty of attempts from those trying to play a break, most notably from one Kyle Bass, who likes to have a go and in fact actually set up a fund purely to have a crack at this breaking. Now, sometimes you do need a bit of patience to sit in trades in this one, playing either side of that band. But as the Hong Kong Authority keep their interest rate 50 pips above the Fed's lower bound, there's little to no carry costs to bear, and rates, tend to move in line with the Fed. If the Fed moves, then usually by that evening, the Hong Kong authorities have moved as well. So I'll be looking at shorts starting around 784.50 up to 785. And then I'll be offloading if I get into any trades down towards 783s. Now, despite the fact that you potentially have a central bank or monetary authority watching my back, I still have a stop somewhere around 790, as you can never rely 100% that something will hold forever. And I learnt some of those lessons from the SMB as well. So, never say never in these trades, but as you can see from the chart there, when it works, it works. You just might need a little bit of patience for it.
Yes, indeed. You just sent a shiver down almost every viewer's spine by mentioning the S&B in January 2015. So we will let sleeping dogs lie with that one, I think, and wrap up the show. Thank you very much, as always, to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining me. Thank you also to our producer, Kyriakos, for bringing this together as brilliantly as he always does. It was brilliant to have him in London last week and meet Ryan in person at very long last. If you have enjoyed the show, which we definitely hope you have, then please do drop a like on the video. Leave a comment as well. Let us know your thoughts on what we've discussed, how you're trading the markets, and if there's anything you'd like us to cover in the show next week. And that is indeed when we'll be back with another episode of The Trade-Off. And it is going to be a very, very busy week to kick things off at the start of May next week. So I hope you can join us then. But in the meantime, thanks again for watching and goodbye for now.